of breaking down what are index funds and how do they impact the stock market. What an index fund is there are three major indices that you will see on display if you turn on a CNBC or if you look at the news. You will see the NASDAQ, the Dow Jones, and the S&P 500. And so for this example, we're going to just talk about the S&P 500. The S&P 500 is made up of 500 individual companies that trade on this index. And so what an index fund is you are basically buying the S&P 500. And if the S&P 500 goes up 4%, then you know roughly your fund has gone up, typically should go up around 4%. However, when you break down the S&P 500, there's 500 companies there, but they all don't carry the same weight in the market, meaning the larger the company is, the more weight or the more impact that it has on that index. So for example, Apple is in the S&P 500, and it is about 4% of the S&P 500, give or take some percentages there, or little decimal percentages. So whenever you're buying an index fund of the S&P 500, 4% of that is going to Apple, where you may have some of these smaller companies that aren't quite getting the benefit of when you're buying this. So that's why you will see some of these very large sways in the market. The other thing that can have an impact is if you're buying into index funds or you're buying into what are called exchange-traded funds, which are either going to be the S&P 500 or possibly, the S&P tech sector. And you're buying all of the stocks that are within that index. And if negative news comes out about one and then you go on and decide to sell that because you didn't like something that came up about Facebook. But when you sell that ETF or that index fund that has Facebook in it, you're not just selling your shares of Facebook. You're also selling the shares of all the other companies that are involved in that, which is then in return going to continue to suppress the market down. Now, this has been known as passive investing, and it's been very, very popular over the last 10 years.